Now, as we mentioned earlier, two big economic headlines are out today. The Fed is expected to raise interest rates again, and the president is meeting with House Speaker Kevin McCarthy to discuss the debt ceiling. For an economic breakdown, let's bring in economist Mitch Roschelle. Mitch, welcome back.
Good morning.
So let's tackle the Fed first. We're expecting only 25 basis points, only 0.25% to raise, and that is after several raises of 75 basis points, 0.75% in 2022. Does this mean we are reaching the end of this cycle of more inflation and raising interest rates and more inflation and raising interest rates?
I think it means the Fed is trying not to overshoot. Let's remember, this is the fastest increase in rates since 1980. And let's remember how bad the inflation, the economy, and unemployment was back in 1980. At least I'm old enough to remember. The other thing, we went from zero. It's like being in a sports car going to 0 to 60. So it's not just that they raised the rates so quickly and so dramatically. It's that from where they came. And that's part of the problem, not to bleed into the next story, but the cost of borrowing for the Federal Reserve and the country has gotten dramatically expensive.
We will get there, Mitch. Don't get ahead of me, man. I want to ask you, though, is there any impact of this today in the markets? Or, I hear the word baked in. Traders are kind of expecting this. People that study the economy are expecting this. Will there be any fallout after it actually happens if it is the 25 basis points we're expecting?
Yeah, it's never the rate increase itself that the market expects or doesn't expect for two reasons. One is market participants are pretty bright about stuff like that. But more importantly, I think the Fed has been tremendously transparent. A little alliteration early in the morning for you, but regarding where they're headed with, individual rate cycles. Many of the Fed governors speak regularly at conferences, and the word sort of gets out. What the market doesn't always expect, and why there's often a big run up right when the release comes out at 2, and then the market goes in the opposite direction at 3 or 3:30 when Powell speaks, is the market participants like to parse through his words about how long this is going to continue. And often it's as much as a word that can move the market.
It really is. He's got tremendous power, and he knows it, and he's very cautious. But we got the jobs report coming out later this week. It is the first Friday of the month. So what are you expecting from that jobs report? And then we can move on to the debt ceiling.
Yeah, what continues to confound me is how strong the job market is, given every other economic headwind, crosswind that's out there. I do think, based upon, the other factors in the economy, I think we're going to start to see the job market cooling off a little bit. That doesn't mean that we're going to see, job declines, but I think the pace of job increases is going to slow because, inflation is certainly taking its toll on businesses. And what happens is, to continue to try to earn a profit, the last thing that they'll cut is workforce.
Yeah, and we just mentioned another 2,000 layoffs coming from PayPal as the tech sector continues to take a beating. Let's talk about the debt ceiling now, though. This meeting between Biden and McCarthy, we know there has to be some sort of a deal because they have to raise the debt ceiling. But so oftentimes, politics sort of takes place up here, and it is not impacting daily life. But this debt ceiling, the borrowing rates, the interest rates, this could have a direct impact on you and I, on any consumer. Can you explain how that works? If the U.S. defaults, and what the results would be for your everyday person just walking around trying to make it through the day if that happens?
Yeah, there's good news and bad news as it relates to default. The Treasury certainly takes in enough money in tax revenue to make interest payments. The problem is we run our country fiscally at a deficit. So because interest rates have gone up, the cost of borrowing money, the government's borrowing money, just think about your credit card. You have a balance on your credit card, and they went from the ridiculous 19% to 22%. Well, that minimum payment that you're making is just not going to cut it.
Thanks for watching. Go to newsnationnow.com to find NewsNation in your cable lineup. And don't forget to click the red subscribe button below to get more of NewsNation's fact-based, unbiased coverage.